Welcome back to Everything Money. We're glad you joined us again. Paul, I wore a couple shirts that weren't flowered and I caught some heat in the comments. So the flowery shirts are back to entice your brain with love from me. Today we are talking about an interesting topic, Paul, because I actually watch our own videos quite intently, Paul. You know, we do a lot of these videos, folks, in sort of one take. If you're watching other YouTubers and it's cut all tight, you know, they may say a certain sentence 4 or 5 times. Most of the time, we're just blathering all at once, Paul, you know. And so, and a lot of times, folks, what Paul's going to hear out of my mouth right now is new to all of us. But Paul, I rewatch our videos, and the Cisco video we did this week was just so eye-opening. I know I've sat here for years now, and I've tried to learn as much as I can from you. And so the Cisco video, we basically showed that this company has had a nice, consistent growth story for 20 years, if you look at the stock ticker, except for this anomaly right around 99-2000, where it just completely exploded off the map and never came back down. So in essence, we basically showed that if you can just avoid this one hype anomaly, or if you didn't, what the future can hold. And I have so many conversations where people cannot separate the success of a company versus the success of the ticker symbol of said company going up.
So fundamentally, I do believe that over long periods of time, big, fast-growing revenue businesses and fast-growing profit will lead to higher stock prices. However, the difference is, my belief is you can overpay for growth. In booming markets, there's no such thing as overpaying for growth in a lot of people's mind. So, back in 2000, these are 3 examples. There are 3 companies we're looking at. One does 200 times more revenue than it did 20 years ago. One does 2.5 times more revenue. One does 3 times more revenue. Profit-wise, this company was losing money. Now it's making a ton. This one's profit doubled. This one's profit went up 4 times. If I told you in 2000 that this was the next 20 years for these companies, would any of these you have thought be lower? That's the point. Everybody always thinks that, oh, it's got more growth potential, therefore it's going to go higher. No, folks. The fundamental belief that I have, which has been proven, is that if you overpay for growth, over long periods of time, the fundamentals will show through and people will care about what kind of return they're getting on their money. This stock is way higher than it was. But guess what? It's only 20 times higher. This stock is down. This stock is down. 20 years later, these stocks are down. And by the way, we're in a very expensive market, and this one's only up 20 times. This one's down. This one's down in a very, very expensive market. Think about that, guys. This company is up 200 times. They were losing money hand over fist, and now they're making money. And they're only up 20 times from their 2000 peak when everybody said these companies are the future, only invest in them. And it's not just these 3 companies. This is Amazon. This is Intel, and this is Cisco. Cisco, as Seth will pull up, there was an article written about Cisco where they said this is going to be the first $1 trillion company of all time.
So at its height, Cisco in 2000 had a market cap of $546.
Billion.
Billion dollars. Of course. Thank you, Paul. 546. Just well, that's very close for Workhorse. So sorry, I get confused sometimes. But here's an article around the same time that says we should never have to use the T word, but we're going to. This is going to $1 trillion. And other articles pulled up just how successful this company was going to be. And I thought in my mind, Paul, I want to go back and see what people were saying, because I wonder if it sounds exactly like
100%
things they're saying today.
It sounds exactly like that. Paul, you don't get the growth. The growth is huge. Well, how much? It's just like real estate, guys. I always hear people say, buy in growing markets. Well, why? Well, because that's where people are going. Therefore, real estate values will go up. Are you sure about that? What about the fact that if in growing markets, there's more supply of real estate? That's what happened in Arizona. Explain to me Arizona, Las Vegas, and all the market crashes. San Francisco, LA, all the major markets were the ones that crashed the hardest in 2008. Why? Oversupply. When you're overpaying for things, over eventually long periods of time, unless you have massive growth. Guys, this is the biggest one to me, because everybody tells me, yeah, but Paul, look at Amazon. Amazon's revenue is up 200 times. You have got to be kidding me that if you believe today that you would have said in 2000, no, it only got up 10 or 20 times. And it took this current market, which is the most overpriced in history, and it's still only up 20 times higher when its revenue is up from $2.1 billion to $430 billion last year in revenue. And you're telling me that 20 times is adequate? No way. If I told you back then this company's got 200 times revenue, you'd be like, oh my God, this stock is going to be, it's going to be up 200 or 300 times easily. But it didn't happen that way. And by the way, I'm not just picking and choosing 3 stocks. Let's go take a look at Microsoft because it's across, and pick any company from 2000 that was a tech company. Look at Microsoft. It hit a peak in 2000 of around $55 a share. Today it's at $287. That's 5 times more. And by the way, guys, Intel, Cisco, Microsoft have bought back a bunch of shares. So if it wasn't for that, their price would probably be lower than it is today. But let's go to the income statement. Last year they did $168 billion. In 2000, they did $23 billion. That's a growth of 7 times. A little over 7 times, and their stock is up only 5 with buying back shares, and it's currently selling for 35 times earnings. So I make the argument here, it took a very overpriced market, it took buying back shares, it took the company surviving, still growing by 7 times revenue, 7 times revenue, the stock's only up 5 times. How is that possible? What about the profit? Let's look at the profit of the business. Last year they did $61 billion in profit. In 2000, they did $9 billion. That's 6 times more profit, and the stock is only up 5. You might sit there and say, well, that's in line, and I repeat, it still took a very overpriced market with a very high PE, and they had to buy back shares. In 2000, they had 10 billion shares outstanding, and today they have 7.5. They have 25% less shares. That drives the price of the stock up even higher because the earnings per share and the revenue per share has now gotten higher.
Paul, you bring up history so much, and so I have normal people conversations out there with people, and it's starting to hit me. And maybe if you're very new at this, Paul, people don't quite remember or weren't even around the idea of the internet and how disruptive it was. And they're saying now that Tesla was, but you and I are 40 years old. I lived in a world for you youngsters out there in the late 1900s where I would write letters to my soon-to-be wife because we didn't have a cell phone. There was no internet. I'm like, and so you want to talk about, like, people have argued with you of like, Tesla's not a car company, even though that 85% of their
more than that, it's like 95% of the revenue
comes from cars.
Yep.
And so, I am hearing these words that you.
By the way,
this is different. This is disruptive.
It's different characters, same plot. Paul, you don't get it. This is totally different now. Okay, I heard that in 2000, and in 20 years from now, people are going to say, "Come on, that was 40 years ago. That's not the real tech." It's always not the real tech after 40 or 50 years. 100 years ago, it was airplanes and cars, right? That was the real amazing tech. It was TV and radio. What about TV and radio 100 years ago? Are you kidding me? Who had a TV 100 years? Was it even invented 100 years ago?
Oh, no.
So I look at it going, guys, it's the same plot, just different characters. 100 years ago, it was cars, airplanes, TVs, radio.
Yep.
50 years ago, it was the nifty 50. 20 years ago, it was internet. Today, it's electric vehicles and meme stocks. Guess what? It's going to end up playing out the same way.
So you warn our new investors who are they're turning 22 this year. They finally have a job, maybe some money. They found our channel. Wrap all this up, Paul, into what can you tell them moving?
If you're looking at growth and say you should pay for growth without having some sort of metrics or fundamentals to it, first off, that's contradictory. Because in terms of growth, you're automatically looking at fundamentals because growth is a big part of fundamentals. But if you're sitting here saying, Paul, I got to pay for growth and I'm willing to pay the most for the most growth without any sort of metric, then what price is too high? If you say, well, come on, what price is too high?
I love where you're going because
you have no price that's too high then.
Mo does a morning show, folks. And for the past, I would say 6 months, Mo, we've been jokingly giving Bitcoin predictions, okay? And we've said on this show a number of times that we just don't believe in the foundation of what these all 10 to 20 to 100,000 crypto coins that'll soon exist are based on. And Mo and I jokingly say that we go to Boca Raton
or Texas
or Austin for the crypto weekend, which apparently exists now.
It's a true thing.
They're true things. We saw a video from Andre Geek pumping some BS. And so, but this morning, Mo, you took a new route in that your new prediction.
I'm a bull.
He's a complete crypto, but he switched.
I'm a bull.
And your new prediction, Mo,
it ruffled feathers.
for this by Christmas is what price for Bitcoin? I want to put this in like new user, normal people terms. What is your new Bitcoin prediction price?
$520 million per coin by the end of 2021.
Now, I absolutely agree with you.
Thank you.
Now all of a sudden, Paul,
The crypto lovers.
the crypto fans
Oh my God.
are upset with
attacking
Mo
me.
for setting unrealistic crypto predictions.
Yeah.
Just like when Tesla was at $60, $70 a share, we thought it was very reasonable. If I'd said to them, okay, fine, what about $700 a share? Well, that's great. Well, that's right now. That's right now. I mean, that's the thing. Everybody always just sits there and says, well, I don't know. Well, then what are we looking at here? If it's not based on some fundamental, I mean, guys, just like the internet. Did I think the internet was going away 20 years ago? If I was around 20 years ago with this mentality, do I think the internet was going away? No. But does that mean I could still be bearish on companies? Absolutely. And this isn't pessimism, guys. I'm the ultimate of optimism. I do believe the stock market and the U.S. economy will be bigger and better 30, 40 years from now than today. But will there be hurdles? Yes. Will we overcome those hurdles? Absolutely. All I'm encouraging our new users to do is say, is it possible to overpay for growth? If you don't believe that's possible, I say look at history. Go back to 2000. Find any company you want that's in the tech sector, even if they're still around today and publicly traded. I can assure you that their stock price has not gone up as much as their revenue and profit has.
Please pull up Cisco because this was just so. We did the video and it's speaking to me, Paul. The ticker price is this is when you Paul, I still have to rationalize these words when you say them because I'm still learning like our viewers. But back in 2000, I overpaid on a hype stock and I never made any money with it.
Look at $80 versus today at $55. It has gone this way, but yet its revenue is up 3 times and its profit's up 4 times. So if I told you at $80 back in 2000, the next 20 years would see revenue go up 3 times and profit go up 4 times. And guys, I repeat, this isn't just Cisco. It's Intel. It's even Amazon. Amazon isn't as high as it should be based on where the revenue
Amazon.
went.
It's the same story, Paul.
Look at Amazon,
For
guys.
new folk, again, I guess I like to just remind folks, you, Paul, that these people weren't maybe around
You
when you
can't
were
even
seeing
see
this.
the blip in Amazon. This doesn't even look like a crash. Guess what? This went from 113 down to 6. Right here. Right here. You don't even see it. It's now at 3,300. Actually, is that even 20 times? Yeah, that's 20 times. So 113 times 20 equals 3260. So it's almost literally exactly 20 times. Yet its revenue is up 200x. Its revenue was 2.1 billion and now it's doing 420 billion. It is 200 times revenue. Its profit, it was losing money. Now it's making 20 some billion a year.
And still growing.
And still growing. And you're telling me that this justifies this actually is only masking what you don't understand. Is that if you overpay, you won't get the upside you think you would if you had 200 times the revenue. 200 times the revenue and the company's only worth 20 times more. And by the way, it's selling for 56 times profit. 56 times profit. When historically 15 to 20 is about the going rate for large companies like this. And it's selling for still over triple what it should sell for. So realistically, this should be a $1,000 to $1,500 company, which would make it 10 times the value from the peak of 2000 when the revenue is up 200 times and the profit is infinitely up because it went from losing money to making 20 some billion. So you'd have to get this one right. And I once had a subscriber of our software do an analysis. If you bought all the major dot-coms and tech companies back in 2000,
Yes.
invested equally in all of them, you would have only doubled your money from now, and 80% of that doubling came from Microsoft, Apple, and Amazon. And keep in mind, Apple was almost dead back then.
Mm-hmm.
So 80% of the gains came from 3 companies. The rest of them, how many of them went even under? The vast majority went to 0. And guess what? Internet's the future. Only invest in the internet. Great, you doubled your money in 20 years. By the way, the market went up 6.6% a year, which would have been about tripling your money in 20 years, quadrupling your money.
I remember in 1999, remember our college friends who were carrying around that stupid iMac that had, it was laughable.
The colored one, yeah.
It was laughable to have an Apple.
Yeah, Apple was pretty bad until early 2000s.
So in the end, folks, why are we doing all this? Why do we get all so fired up about this? We see new people. I just think we're just professional reminders, Paul, that like while other YouTubers keep telling you to buy, they don't bring up downside risk ever. All
They
the
don't bring up
arguments,
fundamentals ever.
all their arguments are in their favor of telling you to buy, and they're making a ton of money off of your back. And the lemmings, Paul, when Kathy Wood, when some other YouTubers are standing at the edge of the cliff cheering you on, and then they jump in the air as you run underneath them and fall off. They're making a ton of money hyping up on the backs of potentially you not knowing what you're doing out
Eventually, they will pay the price, and they will start realizing that profit, revenue, and cash flow are what drive the long term of a company. Absolutely. And it's proven right here. Amazon stuck around, it went up, and even if you paid $113 for it, you still 10x your money in terms of what I think the value should be even today. But if you can overpay for growth, guys. Because at the end of the day, if you love growth, great. One company's growing 30% a year. You'd love that. Say pay whatever. What about one that pays 40% a year? Grows 40% a year. How do you pay more than whatever? At some point, you have to sit there and say, well, 40% a year and 30% is way better than 30% a year. But you're already paying for the nose for this one. Why? Well, because the market's growing at 8% a year. Well, wait a second. Clearly, you have to have some fundamental belief of more growth is worth more money. Is there a point now where above 35%, it doesn't matter, you're just going to pay whatever? No, because clearly 60% is better than 35% growth. It is possible to pay too much for growth. Absolutely. The analogy I always bring is we don't give minor league baseball players $200 million contracts because they're the next potential big hit. Go look at every NBA, NFL. Go look at the history of all drafts. How many of the top picks, how many of the first round picks have Hall of Fame careers?
Bust. Yeah, it's completely, yeah.
How of them, look in the NBA. If you first round pick, half of them don't even play practically some of the times. Or they play like a year.
MLB too. Half of them never
MLB is even worse.
Make it to the major leagues.
Don't even make it to the major leagues. But what you're doing when you overpay for growth is you're paying for future things that haven't happened. Guys, the future's so hard to predict to begin with. That's why I like value investing. The future's so hard to predict. Let's go based on the past. Let's go based on people's sentiment today. Who's beating up today? The future will take care of itself. But if you have to make investments that have to hit all of their projections to even justify it, what are you doing? You're just throwing craps at the table.
Yeah, so in the end, why do we do these types of videos and get so fired up? Like, I just, Paul, you and I have some sense of helping people.
Yeah. Sometimes it doesn't sound like it. Sometimes I get a little right. By the way, our software subscribers sometimes say to me like, Paul, why do you get so many? Because I do believe they're committing financial manslaughter. They truly believe the things they say, but they just don't have any fundamentals based on it. And I want to sit there and teach everybody how to fish the right way. And guess what? We have 5,000 people who belong to our software, right? I don't believe for a second I'm the best investor out of all of them. Mm-hmm. There's going to be somebody in there that ends up being way better than me. I think I'm a pretty good investor. But the reason I'm a good investor is not because of the numbers, it's because of the discipline inside.
Yeah.
Where I can sit there and be proud of the fact that I haven't made money in the last 5 years in stocks. But I've made killings in everything else I've ever done. But guess what? Between now and the next whatever number of years, I will do very, very well in stocks. I will beat the market. I will crush the market, and I'll be very proud of it. And people will have every excuse under the sun as why that happened. But at the end of the day, guys, what matters is I believe in fundamentals, and I do exactly what makes sense. And the people in our chats, their goal is for us to teach them how to think.
For a lifetime.
For a lifetime. Because if you have recency bias is you see the last few years and say this will go out forever, the same thing's going to happen when markets go down. You're going to say, oh my God, this is going to zero. And guess what? People do believe that when markets go down. I've literally had friends, and you think, oh, is that going to be you? It will be you. Unless you come on board, come listen to us, and understand that it's a mental thinking game. I literally had friends in 2007 that I said to them, what happens if stocks fell in half? Oh, we'll buy more. Of course we'd buy more. Stocks fell 37% and they sold everything. Those exact people. Why? Why didn't want to go to zero? If stocks go to zero, the biggest concern you have is not your retirement. It's anarchy. Mm-hmm. If the U.S. economy that would be the U.S. economy going to zero. But your job is to learn discipline and sit there and say, okay, can I overpay for growth? If you don't think you can overpay for growth, man, literally, there's nothing I can teach you.
Well, let me rephrase this, Paul, because taken out of context, a single sentence where you say, I haven't made any money the last 5 years, in real context is you're not willing to overpay.
I think the downside is way worse than the upside in stocks.
Much like this guy named Warren Buffett.
Yeah, Warren Buffett.
where
Warren
he
Buffett
doesn't
guy
buy
is
for 3 years,
he has
where he shuts
$170
down
billion in cash, some obscene amount of money in cash sitting there doing nothing.
You told me this on the phone yesterday. If it's such a wonderful market, and
Why is the biggest
most successful
investor of all time, who's also one of the biggest proponents of the U.S. and the U.S. economy, why is he sitting on $170 billion in cash?
That's what you should be asking as a viewer.
And you might sit there and say, "Oh, he's rich." No, he's just smart enough. And I'm not copying Warren. I've increased my stock holdings in the last few months. It's not a ton, but I am being more active, because the difference for Warren versus me is he needs to make $30 billion acquisitions to move the needle. I don't need to make anywhere close to that, right? So for me, I'm looking at going, if the market's so obviously going to keep going, why is Warren not in it?
Yep. So in the end, folks, be cautious. We get criticized a lot. We're one of the only YouTube channels that 9 out of 10 videos we're telling you not to buy stuff. And that should probably, we think that should be your mindset, is what am I avoiding today? What hype am I avoiding? And if you want a little more excitement in your life, you can be trading with Mo in the Bidnass Nation, where we can follow strict discipline rules to make money on these swings. But in the end, we're value investors, Paul. We want to buy $1 for 50 cents. And some of these hyped companies that other people are pushing are certainly not in our wheelhouse. So that's our take. We hope you guys enjoyed the video and learned something. A more serious note, Paul, but I mean, we in the end, we see a lot of our patrons join us after they get burned. And there's a lot of stories out there, people getting burned on.
The biggest thing I hear from people is, when I heard what you said, it made sense. That's all I ask.
Yep.
And if it doesn't make sense, I get it. There's other ways to make money, but if it makes sense to you immediately, that's what happened with me. All of a sudden, I was like, oh my God, this makes sense. I can explain why a stock goes up over long. Now, do I have a lot to learn still? Absolutely. But the second it made sense to me, I was like, my life just opened up to new possibilities.
Follow the thumbs up, join the Patreon. You can have the software we're using in this video. That's our take. See you next video. Thanks for watching.